Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady, where I help home business owners win the tax game. Home Biz Tax Talk airs Monday through Friday, 9 o'clock-ish. And when you tune into my show, you're going to hear about topics that are important to the home business community. And today we are talking about capital gains. Now, capital gains is something that has really become more of a topic over the last couple of years with the boom in cryptocurrency, because there's a lot of people in cryptocurrency and also in the Forex community as well, because I've seen an explosion of Forex because, now the common person is getting access to these various mediums to invest. And even there are more people that are investing in stocks, even on a small basis. So it's something, this is something that you really need to know and understand when it comes down to your tax life. But it's more of, for my traders are the ones that really need to pay attention and understand how this works, because I've got, traders, whether it's whether they're Forex traders, cryptocurrency traders, stock traders, that are trading, day in, day out, this is how folks wind up getting in tax trouble, not really having an understanding of how all this works. So here we go. All right. So you've got two types of capital gains. You've got long-term and short-term capital gains. Now, long-term capital gains is when you hold a capital asset, which is property, stocks, cryptocurrency is treated as personal property. Okay. So when you hold these items, these assets for more than 1 year, that means if you buy it on August 22nd, 2019, that you can't sell it until August 23rd, 2020 in order to get the capital gains, the long-term capital gains treatment. Now, short-term capital gains is for anything held for less than a year. So that's your stocks and all that. So if you trade in a day, if you trade in 31 days, if you trade in 364 and a half days, that is short-term capital gains. And the short-term capital gains rate is the same as the income tax rate, where long-term capital gains has a more favorable tax treatment. Long-term capital gains has a 0, 15, and 20% tax rate. Your max capital gains rate is 20% unless you have collectibles and all that. That's something completely, that's a whole nother show. Okay, but we're just talking about normal capital gains dealing with assets and stuff. All right, 0, 15, and 20% is your max. Where with short-term capital gains, you've got anywhere from 10% to 37%, depending on your tax bracket, your income tax bracket. So nobody can really tell you what that's going to be until the end of the year. You see how much money you made with your gains. Now, this is where traders get into trouble. Okay. Because when you are trading one asset for another, you're actually selling. So it doesn't matter if you actually put your hands on the money or not. It doesn't matter that you actually go and withdraw or you receive a deposit or anything. It does not matter. What matters is that you have sold one of your assets to acquire another. And when you do that, you owe taxes on the gains. And because traders generally trade on short term, you're talking about the regular income tax rate between 10 and 37%. So when you go and boss out and, with your trading and you make all this money, you owe taxes on that. But where folks get into trouble is, and I've really seen it more in the cryptocurrency world, is when you're doing all this trading and then something bottoms out, right? The most recent horror story I heard, was a college student who wound up owing about $400,000 in taxes because he was trading cryptocurrency and then he had, I think it was Bitcoin, and then Bitcoin bottomed out. So he didn't have the money to pay these taxes because he didn't know that he would owe taxes because he did not physically, withdraw the money. It doesn't matter. So this is why you have to be careful and understand what you're doing when you're doing it. You think, oh, we're just making money. I'm not getting this money, so I don't owe taxes. That is not how this works. You don't have to physically hold the money in your hand or have it in your bank account in order to owe taxes on these capital gains. So let's talk about how this looks. So let's say that you bought something and it was worth $10,000, and then you sold it 30 days later and it was worth $15,000. Well, then that's a $5,000 gain that you owe taxes on. Now let's say that you took that $15,000 and then you bought something, but when you sold it, it was only worth $8,000. Well, then that's a $7,000 loss. Okay. Now, the thing about capital losses, okay, when you trade at an overall loss, then you can only claim $3,000 in that year unless you have trader tax status. And that's a whole nother video. I talked about that previously, but that really is a whole nother video. But on a regular day, for investor purposes, if you have an investor tax status, you can only claim $3,000 in a loss, and the rest of it gets carried forward. So if you're trading and you are, like I said, have a $7,000 loss at the end of the year, you can only claim $3,000, and that remaining $4,000 gets carried forward to the next year to be used to offset other gains. But and also if you're married filing separately, that $3,000 becomes $1,500. Just know that when you married filing separately, that's the worst filing status that there really is because of stuff like this. Okay. But anyway, so $1,500 if you're of a loss if you're married filing separate. All right. So the thing that you need to really keep in mind is when you're trading and you are trading at a gain, that you really do need to set aside some of that money for taxes. You need to set aside 30%, just like with anything else, simply because 9 times out of 10, you may have another job. I have a lot of my home business community that are, that have added Forex to their mix, that have added cryptocurrency to their mix. So they still have other jobs. They still have other businesses. And so this is another stream of income that you also need to reserve money for taxes, because it's going to put you in a whole nother tax bracket. And also understand too, that when you have these capital gains, it can also knock you out of other tax credits. I had an issue one year where I had a client that normally receives their earned income tax credit, but she was dabbling in cryptocurrency and she essentially just made a little too much money. And so that knocked her out from receiving their earned income tax credit. So you've got to really think about what you're doing, in your tax life before you just go off all willy-nilly, because these capital gains do impact your whole picture when it comes down to your tax life. It just does. But the main thing I want you to take away from this is that when you are trading and you have profitable trades, then you need to have some of that money set aside so that you can cover this tax bill when you get it. If at the end of the year you wind up trading at a loss and you have this money saved up, great, then you can go invest it in other things. But what I'm finding, though, is that a lot of people have put themselves into a precarious position with the IRS because, hey, they owe this money based on this profitable trading, even if it bottoms out when you buy something else. That's not the IRS's concern. The IRS's concern is you made these gains, and so therefore you owe the taxes. Okay. Still, as of this recording, letters are going out from the IRS to cryptocurrency users who may or may not have filed taxes to claim their gains or losses on their income taxes. Okay. The letters are going out, and you need to make sure that you read the letter and understand what it says. Anytime you get a letter from the IRS, you read it, open it, and read it. Like, you have no idea how many people don't even open the letters. But open it, read it, make sure you understand what it says. But yeah, long-term versus short-term capital gains, you guys. Long-term gains have more favorable treatment, but traders are normally in the short-term sector. This is where you really got to be careful with how much money that you're making, in the sense that you need to make sure that you set aside that money for your tax bill, and not get caught at the end of the year owing a tax bill and not having the money to pay. Okay, so thank you guys so much for tuning in to Home Biz Tax Talk. Again, we air Monday through Friday, 9 o'clock ish, and you can come right here to get your questions answered about your home business taxes. All right, have a great day, and I will see you all next time. Bye.